Just be aware of that. So each episode, we're going to discuss the theme of investing 101. And today's has to do with debt and equity financing. A metric to understand the debt of a company would be to use WACC, or weighted average cost of capital. So I'm just going to read this excerpt that explains WACC on Investopedia. So to help understand WACC, try to think of a company as a pool of money. Money enters the pool with two separate sources, debt and equity. Proceeds earned through business operations are not considered a third source, because after a company pays off debt, the company retains any leftover money that is not returned to shareholders in the form of dividends on behalf of those shareholders. So, investors often use WACC as an indicator of whether or not an investment is worth pursuing. Put simply, WACC is the minimum acceptable rate of return at which a company yields returns to its investors. To determine an investor's personal returns on an investment in a company, simply subtract the WACC, weighted average cost of capital, from the company's returns percentage. So, what does all of this mean? As long as you read that last sentence, you don't really need to understand the rest of it. Returns equals company's return percentage minus WACC, aka higher the WACC, the more debt the company is in, and the less investment worthy it is, especially in a recession time. So, start integrating WACC into your investments to understand how risky they really are from now on. Please do note that more debt is not always a bad thing. It can mean that the company is more confident in their growth and has more leverage for the growth. But it most certainly is during a period of economic uncertainty, especially for industries that will have to burn tons and tons of cash to stay afloat. So let's get to debt now. Raghav especially, right? He's gonna be talking about tourism. So Raghav, what do you think about debt, and how important was that when it comes to researching companies in your industry?
So a lot of tourism companies were facing massive losses, right? And they needed money to stay afloat, right? So they took out loans, big loans, and that led to a lot of debt, which they have to cover. But some of these small companies might go bankrupt, but a lot of these big corporations are confident that they will recover from this crisis just because of their sheer size. And I always say this, but if you're going to invest, take out a larger portfolio for investing in more safe stocks like bigger corporations. So yeah.